welcome to episode 10 of Thabo and Gugu Life and Business Podcast. I'm Gugu.
I'm Thabo.
Another Q&A.
Thanks. So this is when you try to ask me the hard questions, thinking I'm gonna fumble.
Not really,
fumble the bag.
but I'm sure I'm asking on behalf of other people, so someone out there would like to know something, isn't it, about what you do?
Okay.
Yeah.
About what we do. Oh.
Okay,
Yeah.
Thanks for the correction. So today's Q&A is on the BRRR model. Would you mind expanding on that? First of all, what is BRRR?
Okay, so BRRR is it's the initial stand for buy, refurb, refinance, rent out. Then the E is another R which is added there, which means repeat the whole process. So that's what it stands for.
Okay, that was very brief. Thank you. So, number one, what initially drew you to the BRRR model for property investment?
So for I think the biggest advantage, what drew me into this is you can recycle your cash because you're buying a property, whether it's below market value or you're buying a property to add value to it, So once you've done that, is you buy a property, you add value to it, and you can refinance, which is pulling out some equity from the property. You rent out the property, so you're actually killing two birds with one stone. So you're gonna get rental income, so for the cash flow, and also you're gonna release some equity, which with that lump sum you release, you can go again. So which is that's the last R, which is repeat the process and go again and go again. So it's a good, simple way to actually build wealth when you do this model.
I was about to ask, because why recycling? Why not just save it and put it to the side?
Well, why would you save it for a rainy day?
Yeah, things are tough now, isn't it?
But what would you be saving the money for?
Yeah, that's what I'm asking. So it's just interesting to know what's special about repeating the process.
No, repeating the process, because obviously the process works, and you're as a business owner, it's all about growth, unless you're happy with one
just
property,
the one, yeah.
But if you wanna build a property portfolio, if you want your business to grow, so you just have to recycle the process, So another thing, I just wanna bring it back, because I didn't say always buy at below market value, because there's a myth in property to say, buy below market value, buy cheap, buy everything. No, you can actually buy a property at a market value for what it's worth. But as an investor, you have the eye to say, you know what, if I buy this at this price, I can uplift the value. Yes. By doing certain types of work, extending it, doing a loft conversion, on all these things to uplift the value of the property.
So I guess the secret to that is, as long as the numbers work, you need to do the math first before you go into any investment.
Yes.
And if it works, then price to a certain extent doesn't matter unless the numbers work.
If the end value, if you work out the end value of your end predicted value or your GDV, gross development value, if you work it out and if you can justify it, if you've got strong comparables, you can look and say, look, I think if I do ABC, this property will be worth this much. But you have to have a because that property, for like comparison, is worth that much. That property, it's a 4-bed. This one is a 4-bed. They've done this. It's worth this. So you can have those kind of historic figures.
Realistic and historic figures.
Yeah, realistic and historic.
You can't just guess a number.
No, you can't. And I mean, painting the walls or doing cosmetic work, that's not really adding value, unless the property was distressed, it was in a bad state, modernizing it, that can be adding value. But a lot of people they get that misconcept to say, oh, I painted it, it was orange, I painted it white. Excuse me, you didn't add value to the property.
Hear that? Excuse me. Gotta get that right.
Yeah.
Anyway, no, thank you for that. The next one is, can you walk us through the key steps, the major key steps involved in executing, can you walk us through the key steps in executing a successful BRR strategy?
So I think you make your money when you buy right.
Okay.
So the money is made when you actually buy right, you know. So the first step is actually getting a good property. So whether you're getting it below the market value, or whether you're getting it at market value, you know. So something which we spoke about, you know, you just have to know what's the key point, or what are the key points which I'm going to add value to this property.
Yeah.
So if you're buying it below market value, you actually need to justify it to when you're now refinancing it, to say, look, the true market value of this property was X, but I bought it at Y.
Such and such amount,
You know, and these are the comparables. So with this, I mean, this is a very subjective topic, because it's all about justifying yourself, you know. So you can't even like overpay for a price, then, or for a property, then you extend it, then you add value to it, and you think, oh, because I've done that, I think it's not going to be worth this much. You know, there have to be some sort of comparables, things which you can compare with, and those comparables have to be more like for like. So like the most important step will be like you have to buy the property right,
You have
to start off with. Then after buying, so obviously after buying, you need a power team. You need like a team of solicitors to complete the transaction. You need a mortgage broker who's going to help you to get the finance, the funding, if you're going to leverage on banking institutes. However, if you're buying cash, you don't need them. You still need your solicitor. Then obviously on the second step, on refurbishing, or on refurbing the property, you need builders.
Yep, builders.
So you need the build team, like people who come and look and actually work on the property to add value to it. And you know, but once you're doing that, you actually need a good statement of work, like a scope of works, which is like what exactly are you doing. So if you don't have experience with this, you actually need to get a very, very good build team, like a company. But when you get like a big company to come and develop your property, they're expensive, because they will be charging like overheads, etc. But if you can actually get a small scale builder, it will be actually cheaper for you on the cost. Then the other R is like so once you buy as well, you need to know your exit strategy.
Yeah.
So exit strategy is like your refinance way. You're refinancing, how you're refinancing
In this case,
but like your mortgage broker is there to help you with this, with your refinance exit. Then you need to know your rental strategy, you know, because you bought the property, you've added value to it, you know, you're now refinancing it, you know. So for you, when you're refinancing, you have to be on the correct end product, on the correct mortgage. You know, whether are you refinancing this property as an Airbnb, which is service accommodation, so you need like
the right mortgage in
the
place.
right mortgage, so a commercial mortgage. When you're refinancing this to a HMO, you need like a right product for that, for the HMO.
The
HMO
right
is like
a
house of multiple occupants. When you're refinancing to the healthcare sector, like to supported living, social housing, you need the correct mortgage product for that.
Yeah.
You know, so and the last R is repeat. So like those are the steps which I would advise people to follow. Take.
Thank you very much. So what criteria do you use to identify potential properties suitable for the BRR strategy?
So potentials is like, I rule out flats, like apartments and flats, because with the apartments and flats, it's unless you converting them from like a 1 bed to a 2 bed, which is we've done that.
We've done that before,
in Glasgow, in one of the properties, you know. But like with the flats, it's like it's a standard building, it's already there. You know. So it's unless you
There's also so much you can do in a flat, isn't it?
Yes. So the layout is it's mainly they are purposely built like that.
Yeah.
you know. So it's like the layout it's hard to play around with it unless it's yes. Don't get me wrong. Whoa. Yeah. So you can still add value to flats, but like for a beginner, I always say just shy away from them because you just need a special skill because sometimes you don't actually get the numbers which you want when
From
you're
a
trying
flat,
to
yeah.
from a flat, you know. But if it's a house,
You've got more room to play with.
you've got more room to play with. You can extend out. Other houses they've got a potential to add a loft, you know, so
Yeah.
you can do that. So that also naturally increases the floor space of the house, you know. So there's no questions about it. You've added value there. Yes, modernizing the property, bring it up to like current standard, you know, like other houses are old, like Victorian houses, like maybe they've got two reception rooms. You can take that the reception room, make it a bedroom, you know. So yeah, for my criteria, because we now like going for bigger properties now, so minimum property we're going for is a 3-bedroom.
3-bed, yeah.
Yeah, 3-bedroom, and if they in that 3-bedroom, it has to have scope to be added like a 5 to be a 4, 5, 6, or even a 7-bedroom. Even if we don't do it when once we get it, but we should know like in the future we can still do this.
That's the plan.
That's
yeah.
the plan. It can
So
happen like that.
From what I'm understanding, your main criteria is houses over flats. Then everything else follows. Is that what you're saying?
Yeah, houses over flats. Yeah.
Okay.
Yeah. I'll never buy a flat again.
Speaking from experience, are we?
Yeah, no, it's a nightmare.
How do you assess the potential return on investment for a BRR project?
So ROI, return on investment, is obviously the money which you've invested in the project. So, I mean, every penny. So, like, this is money coming from yourself.
Yeah. So how do you assess it? Yeah.
Well, how do I assess it? Is like, what's my percentage criteria or?
Yes.
Okay, yeah. So
I guess it's just, you know, the spreadsheet calculation just to sort of quickly go through that.
yeah. So I don't have a spreadsheet. Yeah.
Or not in
So
person.
I've got we've got a spreadsheet calculator. Yeah. So I mean, it's very simple. Like, you input the money which obviously you are gonna put in. Like, and obviously with that as well, there is money you're gonna leverage from the banks.
Yeah.
So for me, the money which I'm gonna put in is the 25% deposit. Because it's if you're buying, you need 25% deposit. Then the 75%, which would be like from a bridging company.
Yeah.
Yeah. Then so that 75% obviously it hasn't come from me. It's come from the bridging company. Then for me, I will be paying stamp duty or land and business transaction tax in Scotland.
Yeah.
Then obviously you're paying the solicitors
as well.
the mortgage broker, and like you need money for the refurb
Yeah.
as well.
So it's taking all that into
So
consideration.
taking all that into consideration, and you input those figures in the spreadsheet, and once you've done that, then because you've worked out like your predicted end market value,
Yeah.
you know. So if you can put your predicted end market value, the spreadsheet should also work out like to say, okay, you've put let's say from your own pockets, Thabo, you've put £100,000. So how long will it take for you to actually get the £100,000 back into your pocket? You know.
Yep.
So if it's gonna take me, let's say 4 years, so that means my ROI is 25%. If it's gonna take me 2 years, that means my ROI, my return on investment, the money I have invested into this project is if it's going to be taking 2 years, that means it's 50%.
So 4 years, is that good enough for you, or is that a good or a bad deal?
So I mean that criteria is dependent on each individual, you know, because like to someone else, 10% to get their money back could be a good deal. Yeah. So for me, 2 years, 2-3 years is fine.
It's fine.
I'm happy with it, you know, because we're in this property game for the long term. You know, we're not in this property game for a short term. I remember when we first started, when we were looking for these deals after going to the courses, we wanted to get our money back
In 12 months.
within 12 months. But like, you know, you end up waiting 12 months before you actually get these,
anything.
get this kind of deal.
And that's really stressful.
Yeah, those are called what? Unicorn deals, you know. So within 12 months, if the money comes back, that's great.
And it's possible. It's not to say it's not possible, but
like the time, how long will it take you to look for these kind of deals? The time it takes to look for these kind of deals is just
some things come with experience, isn't it?
Yeah. So
you don't know what you don't know. Do you remember that?
So I mean, the spreadsheet is actually a good thing to have. It actually calculates everything. But those are good questions. You're brilliant.
Thank you.
Where do you get them from?
Wow. I thought I said that before, didn't I? People ask these questions.
Okay.
What are some of the common challenges you've encountered implementing this particular strategy?
Most of the challenges have come from the refurb. You know,
so you're trying to say you're not good at finding good builders at first go?
No, I didn't say I'm not good at that. I said the builders can be challenging. No, not all builders, and it can be like just different trades you've brought in, you know. So I mean that this is where the bulk of the work is, you know. Whereas when you're buying, you're dealing with solicitors, you're dealing with brokers, etc. So it's like that's like, I'll call it the paperwork. Paperwork stuff is usually fine for me, but when it comes to actually the builders, it's either like there is a challenge with the builders themselves or with the property. You know, we can, once you rip it out, once you're now trying to add value to it, you can encounter some challenges which you didn't account for. So that's like more money. For example, when we're doing our recent project which we just completed
in Coventry.
In Coventry, when we ripped out the roof, like we just saw like, wow, like this is like bare kitchen roof, as you can see on this B-roll. It's like when we ripped it out, it was just rotten, and even when we went to view the property, we wouldn't have guessed.
You wouldn't have known that, But then, so to add on to that as well, I guess with obviously the different builders you've had, obviously we've had some challenges, some bad experience with them themselves. However, when you eventually got one who done the job well and right, you've sort of had maintained, sort of now they're now part of your power team.
Yeah.
And you've like built relationships, and like take them on to each of your different projects, isn't it?
Yeah.
Because you've sort of built and maintained that relationship together.
Oh yes. I mean, once you get a good builder, you just need to hold on to them, like, because a good builder is they're like whatever, worth gold, you know.
Yeah.
I mean, because it's hard to actually build relationships with these people, you know, because some of them are transactional. You know, if you add scope of works, they want to charge you extra. Like if you
they don't understand that, you know, this is not just a one-off. It's like you're building something. There's more properties coming.
Yes, that's true. So the guy, the builder who done the Coventry one, will definitely be using him again and again for future properties.
He's really done a good job.
He did a good job. Yes. So, but obviously, like, also we need to find that kind of like power team, like that kind of builder in Glasgow as well for the projects that you're going to be doing. Yeah,
that's true.
Yeah. So before I go into most of these questions which Gugu is asking, I just wanted to tell you about the services which I offer. So I offer a course called Airbnb Mastery Blueprint. So in this Airbnb Mastery Blueprint, there's actually two services there: a 10-day crash course and also a one-to-one coaching program, just teaching you my experiences, the things which I've done to build a portfolio of worth £2 million, which I've used to buy properties using this BRRR model which I'm talking about. And also we've also leased properties from landlords. Right now we've leased about 7 properties from landlords, and all these properties which we've got in our portfolio, we rent them out as Airbnb serviced accommodation here in the United Kingdom. So we operate in 4 cities: Glasgow, Northampton, Coventry and Birmingham. And with that, so if you're interested in actually starting your own property business and want to learn from someone who's in the trenches, who's done this, who's doing this, just click on the link in the description and join the group. And also, we offer another service which Gugu is going to speak about.
Yeah, and that service is Love Your Stays Limited, and that's our Airbnb business, which helps us provide accommodation to different types of guests. And additionally, we're open to joint ventures. So anyone again who's interested to learn on the ground, feel free to reach out.
Oh yeah, so everything is in the description. What's the
couple of more questions, and then
Okay,
so
let's go.
in your opinion, what are the essential skills or knowledge for someone aspiring to be in the property business and do this BRRR model?
Oh wow, that's a good question. So it's funny enough, I've spoke about the Airbnb mastery blueprint. So I mean, well, even if it's not from me, but I'll say get educated. So it's like that's a good skill to have. So get educated. There's a lot of YouTube videos. There's a lot of mentors and coaches. So just look for someone who you relate to. So look for someone who think can hold your hand and get you to the destination which you want to go to. The reason why I say this is you want to learn from their mistakes. You want to learn so you can avoid making those mistakes.
Because mistakes are costly.
Yeah, if you make it, what do I always tell you?
You pay for your mistakes.
You pay for your mistakes, especially in this game. You can pay a lot of money if you make a mistake. So you want to try avoid that. I know there are like some hard crackers there. You like, what? There is information. Yes, actually, I was actually discussing this with a friend. So right now we're in an information overload. There is a lot of
information.
Too much information.
It's just now, I think the trick to it is filtering out the information.
Yes, filtering out the information, because yes, you can actually spend like a year researching about BRR. Trust me, just Google BRR you put that thing on YouTube. You see how many videos come out. Put about Airbnb. There's a lot of videos which come out. So which is and it's great information, but it's like it's not structured, is it?
Yeah, not everyone has it structured. So again, it's
all over the place.
How to filter out what will be useful to you.
Yeah. So I mean, to answer your question, is the number one skill you need
Get educated.
Get educated.
Yeah. Last one. Looking ahead, what trends or changes do you foresee in the property market that could impact the viability of the BRRR model?
So there's a lot of talks now. Like so actually, UK has just come out of the recession, and there's a lot of talks to say.
I wonder for how long.
the property market is gonna crash, etc. So personally, I've never followed those trends closely. So for me, I feel like if you're running a business, you need to run it in any market, whether we're in recession or out of recession. You need to have the skill to actually buy right. So if you're buying, obviously the interest rates are actually high now.
Yeah.
So as long as you factor in those numbers, you factor in everything to consider that the interest rates are high. So it's like, even if you've got a buffer contingencies to say, look, if the interest rates are increased by another 1 or 2%, what does it mean for your rental income? What does it mean for your deal, which your property deal, which you're doing? You need to actually consider those things.
Yeah, and I think also you can correct me if I'm wrong on this. Besides or adding on to buying right, I think it's also because there's different property strategy. Is there ever a right time to buy in property?
No,
with all these different strategies?
No, so the right time to buy is well, there's a saying which is like the best time to buy was yesterday. The next best time is today.
It's today, yeah.
So it's property is one of those things. You don't wait to buy a property. You buy
I'm gonna buy next year.
Yeah, you buy a property and you just wait and see the magic it gives you. It's a forgiving it's a forgiving business as well. So you can actually make a mistake, which, like I said, get educated to avoid that mistake. But over time, like property value always like increases over time. But you don't want to like wait for 1,000 years for that to recover that mistake.
Yeah.
So you just want to like buy right. You know, if you're in recession, you wanna look for distressed properties, but know how to add value to them.
Yeah.
You know, so know how to do everything correct. Otherwise, you buy a house and you can be in negative equity. So
For the
a lot
longest
of
time.
people in
And that's what puts
2008,
people off, isn't it?
2007, they were in negative equity, and some of them haven't come out up to now. You know, so they're still sinking.
Yeah. No, thank you very much. I think that's it for today. Have you
Thanks,
got anything else to add?
No,
How are those
nothing.
questions?
Very good questions. They made me think. So yeah, so I mean, like we said, if you enjoying these video series, you know, and the services which you offer, the 10-day Airbnb crash course, Airbnb master blueprint, everything is in the description. Love your stays. We offer joint ventures opportunities. So if you want to work with us, so just comment below, get in touch with us, and we can work together. Other than that, please like, comment, subscribe. And see you on the next one.
Thank you.
Cheers.